This final chapter, Chapter 4, illustrates the application of Moody's scoring approach to a medium-sized international carrier, Royal Jordanian, to derive its estimated credit rating. Our choice of airline is based partly on the relative simplicity of its financial statements and capital structure, and partly on its location in a part of the world where political and economic underpinnings should be relatively familiar to most listeners. We base our calculations on the company's annual report for 2010, a link to which is provided in the course outline as mentioned before. Beginning with Moody's 4 sub-factors addressing cost structure, we search in RJ's 2010 financials for the airline's fleet age, RKP per full-time equivalent personnel, fuel hedging percentage, and EBITDA margin. Fleet age, whose rating grid from Moody's has been reproduced here, is not disclosed explicitly in the financials, but a little detective work permits us to derive a reasonable estimate for it. This paragraph from footnote 6 to the financials indicates that aircraft depreciation is implemented at an annual depreciation rate of between 4 and 5.5%. This next table from footnote 8 shows depreciation for aircraft owned and aircraft under finance leases to have amounted to some 11 million Jordanian dinars relative to an initial cost of some 310 million. More importantly, accumulated depreciation has reduced the depreciated value of the aircraft to only around 115 million JDs, so to only around 40% of initial cost. Using the low end of the range above, i.e. assuming only a 4% annual depreciation for aircraft over an assumed 25-year useful life, means that the average age of the fleet that is owned outright or subject to finance leases is around 15 years or so, which in itself would result in a rating for this sub-factor of CAA. But Moody's would include aircraft subject to operating leases in its definition of fleet, and so would most airlines. After all, the purpose of using fleet age as a criterion for cost efficiency is principally to assess aircraft maintenance costs, suggesting that no distinction is warranted between aircraft owned or leased, or between finance and operating leases. There is unfortunately no information in the annual report that can assist us in the age estimation of RJ's aircraft subject to operating leases. So we will assume very unscientifically the middle of the range shown in this table, i.e. around 7 to 8 years, or just about in the BAA category. Additionally, we do not know the exact proportion of aircraft represented by operating leases, but we do know that aircraft depreciation in 2010 came to only some 11 million JDs, while rentals for operating leases were around 60 million, 2/3 of which, or some 40 million, Moody's would attribute to depreciation. This suggests that the aircraft under operating leases constitute a large percentage of the total fleet. Continuing to acknowledge the unscientific nature of our approach for want of a superior alternative, we opt for a weighted average rating of BA for this sub-factor. The labor efficiency measure is easier to estimate. This chart here shows for 2010 a figure for RPK of almost 8 billion, and a total of 4,700 employees, resulting in a ratio for RPK per employee of around 1.68 million, which ranks squarely in the CAA category. Jet fuel hedging is also straightforward. RJ states in footnote 38, reproduced here, that like many airlines around the world, it did not enter into any transactions to hedge fuel price risk in 2010, contrary to previous years in which it had used cash-settled call options for this purpose. This results again in the rating of the company falling in the CAA category for this subfactor. We turn now to EBITDA margin, the last of the four subfactors included in Moody's cost structure rating factor. The table you see here, extracted from the annual report, shows for 2010 an EBITDA of around 62 million JDs versus revenues of around 685 million, giving rise to an EBITDA margin of around 9%. This is slightly down from the figure for 2009, which was nearer to 11%, as you can confirm from the third column in this table. Either way, this appears once again to place RJ in the CAA ratings category for this subfactor. But we need to recall at this point that one of the key adjustments Moody's makes to published airline financials is to treat operating leases as debts and to break down the reported rental payments into a financing component and a depreciation component, which will affect the calculation of EBITDA. Step 1 of this calculation takes the current rental expense, shown to have averaged around 60 million JDs over the past 2 years, according to this table extracted from footnote 26 in the annual report. Moody's restates this rental expense by classifying 1/3 of this amount to interest expense and the remaining 2/3 to depreciation. By definition, the calculation of EBITDA is before both interest and depreciation. So the entire 60 million JD of rental expenses needs to be added back to derive the figure that Moody's would regard as the relevant adjusted EBITDA figure. The 2010 EBITDA of around 62 million becomes 122 million, lifting the adjusted EBITDA margin up from around 9% to almost 18%, and achieving for the airline a single B subfactor rating instead of the previous triple C. This completes the subfactors for the cost structure category. The fifth subfactor is geographic diversity, defined, you will recall, in terms of the flight destinations by continent and the share of revenues derived in each. This table here, extracted from footnote 36 of the annual report, shows a reasonably healthy diversity of revenues by geographical region, but the exercise of judgment is called for. Technically speaking, Levant, Arab Gulf, and Asia all form part of the same continent, bringing the share of revenues from Asia to almost 50% of the total. Our view, however, is that Levant and Arab Gulf should be separated from Asia, given the relative independence of these two regions from an economic and geopolitical perspective, particularly for an airline itself located in the Levant. Under this view, the percentage of revenues from each continent, as so redefined, is summarized in the table appearing now, which appears to squeeze RJ into the very respectable single A category for this subfactor. Subfactor 6 is liquidity, defined, you may recall, as cash and cash equivalents divided by gross unadjusted debt. Cash and cash equivalents are reported to be around 45 million JDs, according to this footnote 16 from the annual report, only slightly higher than the figure for 2009. Gross unadjusted debt, which means the debt as reported by the airline, i.e. including loans and finance leases, but not adjusted for operating leases as per Moody's preference, is shown in the liabilities section of the balance sheet, appearing now to aggregate some 72 million JDs, taking into account the four entries for long-term loans, long-term obligations under finance leases, current portion of long-term loans, and finally obligations under finance leases, by which is meant current portion of those obligations. So the ratio we seek to calculate comes to around 61%, placing the airline in the BA category for this subfactor. The seventh subfactor is the degree of encumbered assets, defined to mean total secured debt divided by tangible assets. RJ's disclosure is a little meager on this, but it appears from footnote 19 in the annual report, which we will not reproduce here, that the company's bank loans are unsecured, leaving only the finance leases to represent secured debt. These, as we saw, amounted to 48 million JDs at the end of 2010. The definition of tangible assets, of course, is not completely unambiguous, but at a minimum we would include in this term the company's property, plant, and equipment, which amounts to just over 202 million JDs. As you can see in the asset section of the balance sheet reproduced here. These figures combine to produce a ratio of just under 24%, which earns the company a BA rating for this subfactor. We are left with the calculation of the four financial metrics, the first of which is EBIT to interest. The relevant section of the company's income statement appears now, showing net income for 2010 of 9.6 million, taxes of 248,000, and finance costs, i.e. interest, of 2.48 million. In themselves, these figures would result in an unadjusted EBIT figure of 12.385 million. But here it is necessary once again to recognize the 20 million or so we estimated earlier as the interest component of the operating lease payments for 2010, lifting adjusted EBIT to around 32.5 million. By the same token, the denominator of this ratio would be only 2.48 million unadjusted, but rises to around 22.5 million when we gross it up for that same interest component per Moody's preference. The adjusted ratio for EBIT to interest therefore turns out to be 1.44, which earns a single B rating for this subfactor. Before proceeding, we note that the same calculation in 2009, a much more profitable year for RJ, would have produced adjusted EBIT of some 58.4 million versus adjusted interest of around 22.5 million, once again, resulting in a ratio of almost 2.6, which would have earned a BA rating. And while the information to repeat this calculation for earlier years is not easily found in the 2010 annual report, enough data is available to reveal that the company's results have been highly volatile since 2006, with net income after tax averaging annually around 8 million JDs, so in fact slightly less than the figure for 2010. This being the case, we would not expect the rating agency to give the company the benefit of the doubt as to the likelihood that this ratio will improve soon. We will therefore continue to rate it in the single B category for this subfactor. The next metric is RCF to net debt. Where RCF is defined, we remind you to mean operating cash flow minus dividends, while net debt means total adjusted debt minus total cash and cash equivalents. The relevant section of RJ's financials, reappearing now, reveals operating cash flow for 2010 to have been around 33.8 million JDs, and the company paid no dividend for the year. But remembering that Moody's treats operating leases as debts requires us to add back to operating cash flow the principal component of these leases, or 40 million JDs approximately, bringing the adjusted RCF up to 73.8 million JDs. For the ratio's denominator, we recall that gross unadjusted debt is around 72 million JDs, but that Moody's adds to this a debt equivalent figure on account of the substantial operating leases, estimated crudely at 8 times annual rental income, or an additional 480 million JDs, bringing the figure for adjusted debt to around 550 million JDs. With cash and cash equivalents, as we saw earlier, at 44 million, the ratio in question comes out to be around 14.5%, which technically puts the airline in the single B category for this subfactor, almost squeezing it into the BA category. The last two metrics are debt to EBITDA and debt to capital, which we can dismiss quickly since we have done already most of the work for these. We recall from the preceding discussion that adjusted debt is around 550 million JDs, while adjusted EBITDA is around 122 million, a figure we established when discussing the EBITDA margin subfactor. This leads to a debt to EBITDA ratio of just about 4.5%, which earns the company yet again a BA rating for this subfactor. For debt to capital, finally, we begin by observing from the liabilities section of the balance sheet that total book capitalization is around 385 million, to which we add the 480 million of imputed debt from the operating leases to reach 865 million on an adjusted basis. Total adjusted debt is 550 million, you will recall, which leads, as you can see here, to a ratio of 64% and places the company in the BA rating category for this subfactor as well. We summarize the subfactor ratings along with their numerical equivalents and the weighting for each in this worksheet appearing now. We have calculated on this worksheet a final weighted average factor score of 12.99, as you can see in the cell K18. We reproduce now the Moody's table that translates the overall score into a final rating, and observe that Royal Jordanian would earn a rating of BA3 overall. We note that other factors we discussed earlier in this module may result in a 1-notch or even 2-notch increase or reduction in the final rating Moody's would issue, but will not speculate if these apply here or to what extent. We conclude this module by examining the impact of a change in a couple of the subfactor ratings to illustrate how sensitive this process is to relatively small changes in inputs. Note first that we have programmed in this cell K20 a function that converts the final score from cell K18 into a final credit rating based on the Moody's table we were just looking at. Now let us assume that Royal Jordanian changed its hedging policy and decided to hedge 90% of its forward fuel purchases instead of the current 0. We make the appropriate change in the spreadsheet and observe that the weighted average score declines to 1164. This in itself would lift the theoretical overall rating up from BA3 to BA2, as you can see in cell K20. Next, suppose the airline is able to reduce its percentage of encumbered assets from the current 25% to 0, perhaps by convincing some local banks to provide unsecured loans, which it uses to pay down some of its finance leases. We make the change once again. This would cause the rating for this subfactor to rise from the previous BA to AAA, revealing a new weighted average score of 1032 and placing the airline in the BAA3 category, which is the lowest investment grade category. It is striking that membership in the coveted investment grade club can be achieved in principle with only a couple of minor improvements in 2 of the subfactor metrics. This completes this chapter 4, part 2, and the whole of this module on airline industry analysis.